it going? It's Russell here, and you might have heard that across the country, home sales are slowing down significantly. But what you might not have heard is that there's actually the perfect storm happening right now, and it's partially fueled by the Bank of Canada. Now, this is a situation where the decisions that are going to be made as a result of it are kind of like a bunch of dominoes set up in a circle, except when it gets back to the start, it doesn't stop, it just keeps on going around and around. So in today's video, we're going to go over the truth of what is happening and how the Bank of Canada knows exactly what it's doing. I'll even show you the governor of the Bank of Canada explaining this spiral himself. We'll talk about when the bleeding could stop, as well as how you could potentially set yourself up to benefit from it. Before we get into the fine details, you need to know a couple things. The first one is kind of obvious. If you're living in Canada, you'll know this. Inflation is hitting record highs. Take a look at this. This is where the most recent inflation data came in at 7.7%. And all of these other lines were the Bank of Canada's forecasts for where they thought inflation was going to go. When the forecast was made here, that's what they expected to happen, and so on and so forth. But obviously, that's not happening. We're seeing super high inflation. The cost of living is going up, up, up here in Canada. That's point number one. Point number two is that the Bank of Canada fights inflation by raising interest rates. The Bank of Canada actually uses interest rates as its main tool to manipulate the economy in multiple different situations. Now, to explain this and to go into a little bit more depth, I want to show you a little chart I've made. Through multiple different tools, the Bank of Canada can raise or lower interest rates. Now, that raising or lowering of interest rates can have effects on many different things across the economy. We're going to talk about inflation, jobs and employment, real estate, stocks, and crypto. So if we're in a situation like we were at the beginning of the pandemic, where the Bank of Canada wanted to sort of stimulate the economy, they were going to lower rates. That's this column here. Now, when you lower rates, you can increase inflation because there's more people spending money, right? If it's cheaper to get a loan, it's cheaper to borrow money to go spend more on things. This increases demand inside of the economy, and when we have increased demand and not enough supply, prices go up, right? So rates going down, inflation up. The same goes for jobs and employment, right? When we have low interest rates, businesses can take out business loans at cheap rates, and they can afford to hire more people and to offer more jobs to people. This means that the employment rate also goes up because there's more jobs available. That's what we're seeing right here in Canada, a huge labor shortage because there's just so many jobs available. Same goes for real estate, right? Lower rates means that you can afford more on your mortgage. You can buy more house with less income overall. And the same goes for stocks. We see stocks going up because there's earnings that go up in companies when they can borrow and when they can be more productive. And the same goes with crypto. Generally, crypto right now trades as a risk on asset, much like tech and growth stocks. Generally, when rates go down, that price of that will go up. This is the exact situation we found ourselves in at the beginning of the pandemic. They were afraid that, hey, there was going to be huge job layoffs. Nobody was going to go spend any money. So the Bank of Canada, they lowered rates to cause all of these things to happen, right? To make more people spend more money in the economy, make there to be more jobs that are available, increase real estate prices. People feel like they have a lot more money because all of their investments are going up. They spend more. Woohoo, the economy is saved. But that only lasts for a certain amount of time. We were in this situation with lowering rates for a long time, but now we're entering this era of raising rates, and that's exactly what the Bank of Canada is doing right now. And this raising of rates affects all of these categories inversely to the way they do when rates are going down. We talked about inflation. When there's higher interest rates, people feel less wealthy. They're able to borrow less money. They spend less on things, and that's a downward pressure on inflation and the cost of goods. Same goes for jobs and employment. As you have raising rates, companies won't hire as many people. There aren't as many jobs available over time. Real estate, every 1% that your interest rate goes up, generally that means that real estate prices tend to fall 10% because of the impact that it has on your ability to afford a house. And the same goes for stocks and crypto, not about the mortgages, of course, but just in terms of people's ability to borrow money to invest in these sort of higher risk assets. Now, I want you to keep this chart in mind as I show you this next clip where the governor of the Bank of Canada, Tiff Macklem, recently held a press conference about his review of the financial system here in Canada. This is where the Bank of Canada says, hey, what are the biggest risks to the Canadian economy? And keeping this chart in mind, listen to what he has to say.
But high household debt and elevated house prices are vulnerabilities. If the economy slowed sharply and unemployment rose considerably, the combination of more highly indebted Canadians and high house prices could amplify the downturn. If those highly indebted households lose their jobs, they would likely need to reduce their spending sharply to continue servicing their mortgage. In addition, a big correction in house prices would reduce both household wealth and access to credit, particularly among the most indebted households. Were this to affect many households, it could have broader implications for the economy and the financial system.
So Tiff explains a cycle here that is a little bit dangerous. He says that it could have broad financial impacts if this were to happen in Canada. He says, well, we've got a lot of home buyers here that over the past year, while interest rates were low and real estate prices were sky high, we were seeing a lot of people take on more debt to purchase that home and just barely afford it, right? Now he's saying as a result of those highly indebted individuals, as we go into this interest rate rising situation, those homeowners are going to have to pay more for their houses, especially people who are on variable rate mortgages. Now, as these housing payments go up, these individuals will tend to spend less on other things in order to cover their extremely high mortgage. When we see individuals starting to spend less in the economy, well, yes, we could see inflation go down, but also that could mean we could lose jobs, right? Remember back to that chart, which we'll flick back to in a second. So now if we're losing jobs and we have a high degree of highly indebted individuals here in Canada, well, what happens when those highly indebted individuals start to lose those jobs as a result of the reduced spending as the result of higher interest rates? Now, with rates going up, we're already seeing real estate start to go down in value because people can afford less, they can qualify for less mortgage. But now let's think about what Tiff Macklem, the governor of the Bank of Canada, just said. Well, if we see people tightening their purse strings because they have to cover their mortgages, well, we could see jobs and employment go down, right? Because people are spending less on goods, and that's the very goods that people buy from companies that earn profits from that, and as a result hire more people when times are good or lay off people when times are bad. We could see situations where people are losing jobs here, and that could provide even more downward selling pressure on real estate, because if the people that, like I said, are highly indebted start to not be able to afford this real estate at all, well, they're forced to list, and that's an especially bad situation if they're underwater on their mortgage, meaning that their house is worth less than the mortgage they've taken out on it because real estate prices have dropped since they purchased it. And this cycle can kind of continue, right? Because as we see real estate prices go down more and more, the wealth effect that's generated from the value of someone's assets, generally when someone has a real estate that's worth quite a lot of money, they are able to take out a home equity line of credit on it and be able to spend that money on whatever they see fit. Or even just feeling like you have a house that's worth this much might make you spend a little bit more. But if you're seeing real estate go down in value, well, that means even less spending, right? You feel less wealthy, even less jobs and employment, and as a result, people lose jobs, unable to afford real estate. You can sort of start to see how this cycle starts to happen. Now, the one positive element that we start to see when you have these raising interest rates is, again, the lowering inflation numbers, right? But there is evidence to say that, hey, over the short term at least, even if we raise rates, we might see inflation go up even more, causing the Bank of Canada to raise rates even more, amplifying the effects of everything I've just talked about. Let me show you what I'm talking about. Inflation in Canada is measured through something called the CPI, or the Consumer Price Index. Now, this is made up of a bunch of different components, and it tracks how affordable life is in Canada. Now, this section is all about shelter, right? We see this is the shelter section, and that makes up 26.8% of the CPI. Now, within this 26.8%, there are certain things in here that will increase as we see interest rates going up. We're actually going to see this track of inflation. Some things go up even though we're raising interest rates, which usually will help inflation to go down. Take a look at this. One of the largest components is rent, 6.2%. Well, if we're starting to see a situation where people can't afford to buy new homes, or they want to sit out and wait for the market to sort of get onto the other side of this and start going up again before they buy, we could see an increase of people renting, and as a result, rent prices could go up, and we'd see an even larger raise of this rent portion of the CPI index. Now, the same goes here for mortgage interest costs. As we're seeing the interest rates go up, well, people are going to be paying more interest on their mortgages that they take out, and we could see growth in this number as well. So as a result of this, we could see, again, the CPI go up, and the Bank of Canada will look at that and say, hey, we're not doing enough here when we're raising rates. Inflation is still high, causing them to over dramatically raise interest rates even further. And like I said, higher interest rates means all the things we talked about before, less jobs, lower price of real estate. You can sort of see how all of these factors can start to play into each other. The big question that we're facing here is whether or not the Bank of Canada can achieve what they're calling a soft landing, where they can slowly raise these interest rates and get inflation back down to target around 2%, 3%. That's where they want to see it. They're hoping that they can raise these interest rates and nothing's going to break in the meantime while they bring down inflation. If we see the CPI numbers tick down next month, that's probably a good sign because it signals to the Bank of Canada, hey, the tools you're using, well, they're working. You don't need to be as aggressive with your interest rate hikes. But if we see that inflation continue to trend upwards, the Bank of Canada might be even more aggressive. And now, in my personal opinion, I don't think that the Bank of Canada has as much room to play with their interest rate increases as some other people do. Let me show you a recent chart. This report was released on June 22nd, so it's rather new, and it's from Manulife Bank, and this is their spring debt survey, where they sort of take a survey of 2,000 different Canadians that they think adequately represents the total population and get some insights from it. But here we can see that as a result of this survey, they have the information that says that 1/5 of homeowners believe they can no longer afford the house they own as a result of these raising interest rates. Canadians are 5 times more likely to report their spending is outpacing their income. They're spending more than they're bringing in, and 50% of people are considering reconsidering their summer vacation plans due to the affordability concerns. This is the less consumer spending that I was talking about, and 25% of homeowners believe they overpaid for their home, and 84% of people expect that we're going to continue to see higher interest rates and higher inflation over the next year. Given the numbers trending in this direction, I think at some point, with the Bank of Canada continually raising interest rates, something is going to break. They don't have as much room as they think they do. And when something breaks, well, they'll be forced to do something about it. And what do they do whenever there's a big problem in the economy? Well, they take out the money printer and they start printing a bunch of money, adding a bunch of money to the system to lower interest rates and to increase spending, just like we did at the beginning of the pandemic. And at that point, we're right back to the situation mid-pandemic where we see soaring real estate prices, high stock prices, but also as a result, higher and higher inflation. I think that the Bank of Canada's kind of backed themselves into a corner, much like many other central banks across the world, where when something breaks, they need to turn on the money printer. Otherwise, there's going to be a lot of human cost. The only question, folks, is when is this going to happen? And that's something I can't tell you and nobody can tell you. How long are we going to last until something breaks and the Bank of Canada's hand is forced? That's something I'll be watching very closely. But what if you're in the market right now and you're looking to either sell or to buy real estate over the next couple of years? Well, these are just my opinions and don't take them as financial advice or real estate advice, but you can use it to form your own opinion. Now, if you're a buyer, over the next 6 months to a year, we could see a lot of opportunities as there's more and more selling pressure as a result of the things that we talked about in this video. More and more people that are over leveraged, that can't make the payments and need to sell their properties. When you have sellers that are in financial distress like that, you can often get a property for a rather good deal. Now, if you're on the flip side and you're a seller, it is in your best interest most of the time to not sell if at all possible. Take a look at the rental market right now. Like I said, we're going to see rent prices increase here over the next little while. In fact, we're already starting to see that. Perhaps the rent on your property would be able to cover the mortgage payment if you're getting really tight for cash. Selling in this type of market is really challenging, and I don't recommend doing it if at all possible. And that expands to a more general tip for buyers and sellers. Whenever you're looking at a property, make sure that the rent payments that you could get if you were to rent out that property would be able to cover your mortgage in a worst case scenario. That way, if there's a downturn like we could be seeing right now, you know that you're not going to be forced to sell at that worst time possible. I always recommend to new homeowners to consider house hacking as an option. That's where you buy a property with the idea in mind that you're going to rent out a portion of it to supplement your income to cover the mortgage. That's what I do with my house. I live upstairs and I run an Airbnb in the basement. Now, as a result, if I were to lose my jobs, lose all of my streams of income, well, in that situation, I could rent out both floors, the upper floor and the bottom floor, maybe move out and find a cheaper place, but not be forced to sell in a worst case scenario, allowing me to hold on to that property for the long term as my mortgage debt gets paid down, and hopefully over the long term the value of the home goes up. It's definitely going to be interesting to watch over the next while. It's an uncertain time, but whenever I see something, I'm going to bring it to you right here on the channel. So subscribe if you haven't already done so, and let me know down in the comments, what do you think of all this? What do you think is going to happen? Am I wrong in any areas? What do you think? I'm sure there are a lot of opinions out there, but with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.